For years, most investors believed the global financial system would always revolve around the US dollar. But recent moves by China suggest something much bigger is happening behind the scenes. Quietly, strategically, and without dramatic headlines, China appears to be reducing its dependence on the dollar while increasing its focus on gold, silver, and yuan-based trade systems. This shift is not just about politics. It's about control, stability, and preparing for a future where the dollar may no longer dominate global trade the way it has for decades. What is de-dollarization? De-dollarization is the process where countries reduce their reliance on the US dollar for trade, reserves, and international payments, instead of holding large amounts of US Treasury bonds or settling trade in dollars. Countries begin using gold and silver. Local currency external payment systems. Commodity-backed agreement. China is currently leading one of the largest de-dollarization efforts in modern history. What China is doing right now, according to recent reserve data, China reduced its holdings of US Treasuries again, pushing them to the lowest level seen since 2009. At the same time, China continued adding gold to its reserves. On the surface, these may look like separate actions, but together, they reveal a much larger strategy. China is selling US debt, buying gold, expanding yuan-based trade systems, building financial infrastructure outside Western control. This appears to be the second phase of a long-term plan. Phase 1, diversification. Near the early stage, China slowly reduced dollar exposure while avoiding panic in global markets. Treasury reductions happened gradually, and gold purchases remained modest and controlled. Phase 2, active de-dollarization. Of the pace is accelerating. China is no longer simply diversifying reserves. It is actively creating a parallel financial system where countries can trade without using the dollar at all. The biggest sign of this shift is the rapid growth of China's cross-border interbank payment system, often called CIPS. Why CIPS matters? Think of the global financial system like an international highway. For decades, almost every major trade payment traveled through the US dollar system using SWIFT. That gave the United States enormous financial power because global trade depended on dollar access. Now, China is building another highway. Using CIPS, countries can settle payments directly in yuan instead of dollars. Imagine Saudi Arabia sells oil to China. Old system, China pays in dollars, payment moves through SWIFT. Saudi Arabia recycles those dollars into US Treasuries. New system, China pays in yuan through CIPS. No dollars involved. Less demand for US Treasuries, more global acceptance of the yuan. When this happens repeatedly across energy, commodities, and trade agreements, the global demand for dollars slowly weakens. That's why many analysts believe gold and silver could benefit massively over time. Why gold and silver could surge? Gold and silver have historically acted as monetary assets during periods of currency instability. If central banks lose confidence in the long-term strength of the dollar system, they often increase precious metal reserves. China has already been aggressively buying gold, and many analysts believe actual purchases may be far larger than officially reported. Silver becomes even more interesting because its market is much smaller than gold. Industrial demand is growing rapidly above ground. Inventories are tighter. Instant demand can spike quickly during monetary uncertainty. Gold rises during major monetary shifts. Silver often moves even faster in percentage terms. The supply pressure at global gold production is limited every year. If major central banks continue buying large amounts of gold while private investors also enter the market, supply shortages begin forming naturally. Silver faces a similar issue. Industrial sectors already consume huge amounts of silver for solar panels, electronics, technology, military applications. Of governments and central banks also begin stockpiling silver strategically, the supply-demand imbalance could become extreme. That's where long-term price repricing becomes possible. What could trigger the next stage? Several major events could accelerate this transition. A serious US-China geopolitical conflict, new sanctions against China, major treasury market crisis, rising inflation, and declining confidence in fiat currencies, more countries joining yuan settlement systems. Key point is this: the transition does not require a sudden collapse tomorrow. It only requires time, momentum, and continued movement away from the dollar system. And that process is already happening. What investors should understand: many people still view gold and silver only as inflation hedges, but the bigger story may actually be monetary restructuring. If countries continue reducing dollar dependency while increasing gold reserves and yuan-based trade, precious metals may eventually be repriced as strategic reserve assets rather than speculative investments. That does not mean the dollar disappears overnight. It means the world could slowly move toward a multi-currency financial system where the dollar remains important but no longer dominates alone. For investors, the real question becomes: how much exposure should you have to assets outside the traditional dollar system? That answer depends on your risk tolerance or timeline view of global monetary change. But one thing is becoming increasingly difficult to ignore: China's shift away from the dollar no longer looks temporary. It looks systematic.